Welcome to our FRM Part I tutorial on how firms manage financial risk. In this session, we will connect the textbook foundations to real-world practices. So you not only remember the terms for the exam, but understand how decisions are actually made in treasury and risk teams. By the end, you will be able to explain how firms hedge, how they set risk appetite, what makes a good limit framework, and how to choose between instruments like forwards, futures, swaps, and options. Let's get started. Let's begin with the learning objectives. By the end of this chapter, you should be able to compare different risk management strategies and explain why each one is appropriate. You also need to understand risk appetite and how it gets translated into daily decision making. A second major objective is evaluating the advantages and disadvantages of hedging. Hedging is not automatically value creating. In some settings, it improves planning, lowers expected distress costs, and stabilizes operations. In other settings, it adds cost, complexity, and false confidence. You also need to apply methods for hedging different kinds of exposures, including commodity price risk, foreign exchange risk, and interest rate risk. And finally, you need to assess risk management tools such as limits, derivatives, and governance structures. For the exam, the key is not isolated memorization, but the key is integration. You should be able to connect appetite, exposure mapping, instrument choice, execution risk, and post-implementation review into one coherent framework. Why is risk management central today? Two reasons: need and opportunity. Beginning in the 1970s and accelerating afterward, firms faced a very different environment. Deregulated financial markets, higher volatility, global sourcing and sales, larger balance sheets, and more leverages. That means a non-financial firm is no longer just exposed to the success of its product, but also exposed to commodity prices, exchange rates, interest rates, credit spreads, supply chain disruption, and refinancing conditions. A bank or financial institution faces even more layers of exposure. At the same time, financial innovation created new tools. Firms gained access to forwards, futures, swaps, options, securitization structures, and increasingly specialized transfer markets. This expanded the menu of possible hedges. But this chapter stresses on essential warning. Financial innovation does not eliminate risk, but it redistributes risk. In many cases, it also transfers risk. A simple business exposure can become a complex combination of market risk, collateral risk, liquidity risk, counterparty risk, and operational risk. So the modern imperative is not just to hedge, but to hedge intelligently and within the firm's actual capability. Here is a simple roadmap you can use in any risk setting. Step number 1, identify risk appetite. Clarify strategic goals and willingness to bear risk. Step number 2, map risks. Pin down exposures at cash flow levels and compare tactics using cost benefit or ROIC. Step number 3, operationalize. Turn philosophy into policies, metrics, limits, staffing, and governance. Step number 4, implement. Select proper instruments, execute day-to-day decisions, and oversee positions. Step number 5, re-evaluate. Markets, tools, and business change, so you should also change. Your approach should change. Think of this as a loop, not a line. Now we come to one of the most important conceptual debates in this chapter. Should companies hedge at risk at all? The argument against hedging starts from classical finance. If investors hold diversified portfolios, the company's specific volatility is largely diversifiable. In that framework, shareholders can manage their own risk exposure, so they may not need the company to spend money reducing specific risk. But the argument in favor of hedging is grounded in market imperfections. Real markets are not frictionless. Companies face taxes, transaction costs, internal financing costs, distress costs, supplier concerns, and consumer concerns or customer concerns. Because of these frictions, reducing volatility at the firm level can increase value. So the practical answer is not always hedge or never hedge. The practical answer is hedge when reducing risk supports real economic value. For example, if hedging protects investment capacity, reduces the probability of financial distress, stabilizes pricing, or preserves access to funding, then it can benefit the firm and its stakeholders. Go ahead with that. That is the exam takeaway. The value of hedging depends on imperfections, incentives, and the specific business context. Here we give both the rationale for hedging and the caution against overconfidence and financial engineering. Why do firms hedge? One reason is to support stable pricing and contracting. If a firm can offer customers predictable prices, it may increase demand and improve planning. Another reason is to lock on profit margins and make investment projects feasible. Hedging can also reassure lenders, suppliers, rating agencies, and customers by reducing the probability of severe financial distress. But now, the caution. Just because a derivative exists does not mean a risk should be hedged. Not every exposure is material. Not every hedge is cost-effective, and not every reduction in short-term earnings volatility translates into long-term economic value. This is where candidates often make a mistake. They assume lower reported volatility is automatically good. But a hedge has explicit costs such as premiums and bid-ask spreads, and implicit costs such as basis mismatch, operational burden, model risk, and poor communication. A complicated hedge can become a hidden directional bet. So the key principle is this: financial engineering is a tool, not a substitute for sound judgment. Just because a derivative exists does not mean you should use it. Hedging often stabilizes near-term earnings, but may not eliminate long-term uncertainty. Costs can be visible like option premiums, or hidden like model error, basis risk, or operational complexity. And if a structure behaves like a leverage view, it can amplify, not reduce risk. The key is fit for purpose simplicity, if possible at all. We now move from concept to governance. A firm or a bank begins with a high-level risk appetite statement, but that's only meaningful if it can be translated into concrete business line actions. Risk appetite should define what types of risk the firm is willing to assume, at what scale, and for what reward. But it must be then converted into concrete mandates and thresholds. That means specifying metrics such as notional exposure, value at risk, stress losses, earnings at risk, duration gaps, concentration limits, or the ROOC. Let me pause on one exam relevant distinction here. Risk appetite is the amount and type of risk a firm or a bank is willing to take in pursuit of its objectives. Risk capacity, on the other hand, is the maximum amount of risk the firm can absorb before breaching capital, liquidity, regulatory, or solvency constraints or requirements. And risk limits are the operational controls used to keep actual risk taking inside the desired zone. A risk profile is the existing actual status quo of the firm. You should also specify the time horizon, legal entity, and product scope. A group-wide appetite is not enough if subsidiaries, desks, or treasury units operate under different realities. And finally, compensation should align with risk philosophy. If staff are rewarded for short-term gains without accountability for tail risk, the stated risk appetite becomes meaningless. This is one of the most practical parts in this chapter and one of the most testable in the FRM exam. Risk mapping begins at the cash flow level. You ask what amount is exposed, when does that exposure occur, and which currency, under what price or rate reference, against which counterparty, and under what contingencies. This is important because many firms and banks hedge too early at the instrument level. They jump directly to a swap or an option before fully understanding the actual business exposure. That is the drawback. First, map the exposure. Then choose the treatment. You should identify both current positions and probable future transactions. This includes forecast sales, input purchases, refinancing needs, and contingent liabilities. The firm or institution also needs to define how much uncertainty is still acceptable. For example, should hedge 100% of next quarter exposure, only a portion, only committed exposures, only highly probable forecast exposures. Those policies and decisions really matter. Then look for natural hedges. For example, foreign currency inflows may naturally offset foreign currency outflows, or liabilities may naturally offset assets with similar repricing sensitivity. Natural hedges are generally cheaper and simpler than derivative overlays. Finally, the firm should not ignore hard to quantify risks such as cyber catastrophe, operations, and data privacy. These may be harder to model, but they can still be really material. Once the firm understands its exposures, it chooses among 4 broad responses: retain, avoid, mitigate, or transfer. We have already discussed these concepts in our previous video, and we do it again here. To retain risk means the firm deliberately keeps it, usually because the exposure is core to its business, well understood, and appropriately compensated. For example, a bank will retain some credit risk because taking credit risk is part of its business model. To avoid risk means the firm exits or refuses an activity because the risk is outside its competence or not fully or adequately rewarded. To mitigate risk means reducing the frequency or severity of loss without fully transferring it. Examples include diversification, strong controls, collateral arrangement, process redesign, or operational safeguards. To transfer risk means shifting it to another party through insurance, derivatives, securitization, or any form of contractual pass-through clauses. This 4-part framework is important because derivatives are only one branch of the decision tree. Many exam questions try to see whether you understand that the best choice may be to avoid, redesign, or naturally offset an exposure rather than mechanically hedge it. After identifying the strategic options, the firm evaluates them using disciplined decision criteria. The first criterion is severity and urgency. Which risks are large enough or time-sensitive enough to require immediate action? The second is cost-benefit analysis. Here, you compare the cost of the hedge with the reduction in expected loss, tail loss, volatility, or distress probability. In a more advanced framework, you might think in terms of risk-adjusted return or capital efficiency. A useful exam-oriented expression is the calculation of ROIC, which we already have calculated in our previous video. The point is not that every problem will require calculation, but that firms need a way to compare reward with capital at risk. The third criterion is alignment. A strategy might be profitable but still inconsistent with the firm's stated risk appetite. The fourth criterion is capability. A hedge that requires dynamic rebalancing, collateral management, independent valuation, and intraday monitoring may be inappropriate for a firm that lacks the systems and controls to handle it. So, the best strategy is not merely the most elegant one. It is the one that is economically justified and operationally sustainable. Here we should pay attention to a major governance lesson. Do not run a sophisticated risk program with an unsophisticated infrastructure. Simple hedges require relatively modest support, but once the program becomes dynamic, leveraged, bespoke, or collateralized, the required infrastructure rises sharply. The firm needs specialized models, market data systems, collateral operations, legal documentation, valuation controls, accounting expertise, and independent risk oversight. A good risk manager should immediately think in terms of the three control layers: execution, risk control, and back office settlement. If the same people design, book, value, and monitor the position, control weakness is almost imminent and guaranteed. This is also where model risk enters. A complex strategy is not truly controlled if the firm relies completely on dealer pricing and does not have internal capability to understand valuation, sensitivity, and scenario behavior. The board level question is simple but powerful. Is our sophistication appropriate for our chosen strategy? Many historical failures occurred because firms adopted structures that exceeded their own control capacity. Here the question is how firms turn appetite into day-to-day control through a limit framework. A stop-loss limit caps realized losses over a period, but it does not eliminate future exposure. It is reactive rather than preventive. A notional limit is simple and easy to monitor, but it can be misleading. Two options with the same notional can have very different economic risk, especially when options or other structured products are involved. A gap or maturity limit helps control repricing concentrations and refinancing bunching. This matters especially for treasury and asset liability management. A concentration limit prevents excessive exposure to a sector, obligor, country, currency, or instrument type, but concentration metrics can fail under stress if correlations rise sharply. Then we have Greek limits and VAR limits. These are more risk sensitive but also more model dependent. Senior management may simply misunderstand them, especially if governance is weak. Finally, stress and scenario limits are particularly valuable because they force the firm to ask what happens in severe but plausible conditions. For the exam purposes, remember the hierarchy. Simple limits are easy to use but may be crude. Advanced limits are more informative but depend more heavily on models and assumptions that may not be true under different conditions. So remember this part. Now let's review the basic derivative tools. A forward contract is a customized bilateral agreement to transact at a future date at a pre-agreed price. It is flexible but exposes the parties to bilateral counterparty risk. We will discuss these concepts later in other videos. A future contract, on the other hand, is a standardized exchange-traded forward-like instrument with daily margining. It offers greater liquidity in lower bilateral credit exposure, but less customization. A swap is an exchange or cash flow streams. A common examples are interest rate swaps and currency swaps. Swaps are powerful because they let firms transform exposures without changing the underlying asset or liability. An option gives, on the other hand, the right, but not the obligation, to buy or sell at a specified strike price. Options provide asymmetric protection. That asymmetry is valuable because the user keeps favorable upside while limiting adverse downside, but it comes always at a premium cost. For the exam, remember the following. Forwards and futures are generally obligations, swaps are stream exchanges, options are rights with asymmetry. That asymmetry is often exactly what firms want, but that is never free. You have to pay for that. Now we are comparing exchange-traded and over-the-counter derivatives. Exchange-traded derivatives are standardized, centrally cleared, and generally more liquid contracts. Daily margining reduces counterparty credit risk, although it introduces new liquidity demands because adverse price movements create variation margin calls. We will discuss margining and these types of derivatives in our future videos. OTC derivatives are more customizable. That makes them attractive when a firm needs a hedge closely tailored to a specific cash flow, maturity profile, or business exposure. But customization, of course, comes with trade-offs. Less liquidity, more documentation, more counterparty risk, and greater valuation complexity. One subtle point for the exam is this. Central clearing reduces counterparty risk, but it does not eliminate risk. It transforms part of the risk into collateral and liquidity management risk. So when comparing exchange-traded and OTC contracts, do not think only about credit risk. Also think about standardization, basis fit, liquidity, collateral terms, operational burden, and accounting treatment. All these concepts will be discussed in our future videos. Let's have a look to a classical applied example from the original GARP materials. For airlines, jet fuel is a major and highly volatile cost. In principle, hedging fuel exposure seems straightforward, but in practice, the firm may not always have a perfect jet fuel derivative available at the right tenor and liquidity. So it may hedge using related instruments such as crude oil or heating oil contracts. That creates basis risk. The hedge instrument and underlying exposure do not move perfectly together. So even if the hedge is directionally sensible, the spread between jet fuel and crude oil can widen or narrow unexpectedly. This is a very common exam concept to remember. A hedge can be effective against broad market direction and still be imperfect because of basis mismatch. Options are often attractive here because they preserve upside. For example, if the fuel prices rise, the option protects the airline. If prices fall, the airline can still benefit from lower fuel costs, minus, of course, the premium. But that flexibility is really expensive. The correct way to evaluate the hedge is ex ante, based on the objective and information available at the time the decision was made, not ex post based purely on whether the hedge really made money. We have to remember that interest rate risk management is more complex than simply predicting rates. A firm's approach to rate risk depends on its risk appetite. Does management want stable interest expense? Does it prefer floating exposure because it expects rates to fall? Or is the goal to align debt sensitivity with asset sensitivity? Practical market considerations also matter. A firm may be able to borrow more cheaply in one market and then use a swap to transform the exposure into the desired form. This is a standard reason for using swaps for most of the banks and institutions. Business need also evolve. For example, refinancing window, acquisition plans, capital spending, and cash flow timing can all change the desired interest rate profile of an institution. Regulation and tax treatment also matter, especially for financial institutions. And finally, yield curve behavior also matters. A firm is not just exposed to rates in a single numbered sense, it may be exposed to curve shift, like steepening curve, flattening curve, basis changes, and receipt timing. And simple form fixed rate debt has relatively lower sensitivity in terms of future coupon uncertainty, while floating rate debt has higher sensitivity to future receipts. Duration provides a useful approximation of price sensitivity, which we will discuss all these concepts in our future sessions. This slide is critical because the FRM exam often tests the failure modes, not just the intended mechanics. A hedge can fail because the firm misunderstood the original exposure. If the risk was mapped, for example, incorrectly, the hedge may address the wrong variable. Failure can also arise from structural market change. Historical relationship that seems stable may break down under stress condition. Another cause is excessive complexity. A program may look elegant on paper, but be too complex for the firm's system, staff, reporting framework, or governance structure. Communication failure is another major issue. Senior management, boards, or investors may not understand that a risk management program can still produce losses, collateral calls, and severe short-term cash demands. There is also the danger that a so-called hedge is actually a carry trade or earnings smoothing strategy in disguise. That means the position is not really reducing risk, but it is adding hidden exposure. And finally, rogue trading remains possible if independence, oversight, reconciliation, and documentation are weak. Here, this slide reinforces a central message. Hedging failure is often a governance failure, but it becomes a market loss. MGRM example is one of the most famous cautionary cases in corporate risk management. Meta-Gesellschaft Refining and Marketing promised customers long-term fixed price supply contracts for gasoline and heating oil. That meant the firm had a long-dated economic exposure. If energy prices rose, MGRM would suffer because it had promised fixed delivery prices. To hedge that exposure, the firm used a large rolling program of short-dated futures and swaps. Conceptually, this was a stack and roll hedge. Now, here is where the problem emerged. When the oil market shifted from backwardation to contango and spot prices fell, the short-dated hedge positions generated large margin calls. So even if the long-run economic logic of the hedge had some merit, the firm faced immediate liquidity pressure. That liquidity drain became so severe that the firm had to liquidate the hedge positions at a loss, of course. Later, when the market reversed, MGRM still had the original commercial commitments but no longer had the protection in place. In effect, it was hit twice. The case teaches several exam-relevant lessons. First, maturity mismatch matters. You will learn all these in asset liability management part of the program later in our future videos. Second, liquidity risk can destroy a hedge before the long-run economic playout. Third, a hedge must be evaluated not only by market logic, but by funding capacity and governance robustness. Let's consolidate the key messages of this chapter. Always begin with the business exposure, not the derivative instrument. The instrument is the response, not the starting point. Use natural hedge first whenever possible. They are often cheaper, more transparent, and easier to govern. Remember the distinction between risk appetite, risk capacity, and risk limits and risk profile. Appetite is what the firm wants to take. Capacity is what it can survive. Limits are how it enforces discipline in practice. And of course, profile is the status quo. The strategic choices are retain, avoid, mitigate, and transfer. Derivatives belong mainly in the transfer category, but they should only be used after considering cost-benefit trade-offs, basis risk, counterparty risk, liquidity strain, and of course, governance burden. Exchange-traded contracts improve standardization and typically reduces bilateral credit exposure, while OTC contracts offer better customization at the cost of greater complexity. And perhaps the most important lesson is a hedge can destroy value if it creates hidden optionality, unacceptable liquidity needs, or misunderstood downside scenarios. And real firms, communication, culture, infrastructure, and control are just as important as pricing formulas. To log this in, try the practice question linked with this session below. See you next video. Thank you.